Welcome to our weekly market review, and 2023 is on its back. Here we are in December, and for the first week of the last month, we've got Q3 GDP figures coming out. The market is expecting a flat GDP reading. South Africa's economy is simply not growing. It's being hobbled by maladministration, load shedding, and crumbling SOEs. National Treasury had to step in again and provide a 47 billion rand lifeline to Transnet in the form of a guarantee, so it can raise capital for it to reform its operations and upgrade its infrastructure, which, if done correctly, is some positive news. Now, the accompanying current account data will also provide some insight to foreign investors about the size of the deficit South Africa needs to plug. It's simple, really. The bigger the deficit, the higher the discount South Africa will need to offer to keep its attraction to foreign investors. Now, funding is already a tough task given South Africa's risk premium, and so the larger the account deficit, the more prone the ZAR will be to volatility. In the medium term, though, it is the dollar which will be providing the general direction. Now, the greenback is highly overvalued, and it is vulnerable to reversing its multi-year bullish bias. Although last week's data showed that American inflation is on track to come in lower than the Fed's forecasts, Fed Chairman Powell's forward guidance on Friday was mixed, saying that the central bank will move cautiously. The market now has more than 125 basis point rate cut risk priced in for 2024. Bank of England Governor Bailey has also pushed back against a narrative of a policy pivot, saying that any rate cuts are unlikely for the foreseeable future and warning the fight against inflation is far from over. Meanwhile, the fight over in Europe is seemingly on track. Last week had the prelim CPI data for November showing a surprisingly strong disinflationary impulse. Money supply data has also shown that credit supply is drying up. The risk of economic contraction heading into the end of the year is therefore rising. So the ECB may have to turn more growth sensitive sooner than what it is signaling. Other interesting data out this week. Locally, we have the BER's Consumer Confidence Index, and then internationally, China's PMIs will be out, which will give a fresh read on the country's services sector. The industry has been driving the lopsided recovery in recent months. Markets will also be tracking US jobs data, and any signs of weakness in the labour market will bring the expectations of eventual rate cuts forward. That then the week that wasn't the one to come for the markets.